Good morning, students. So today we are here to make a very quick discussion on partnership accounts. So here we go. So our discussion is basically this is a very quick discussion on partnership accounting. Partnership accounting is a very big chapter in accounts. So here I have tried to compile the most important elements of partnership accounts and cover the most important things which are there in the syllabus, so that in one place you find comprehensively all the important matters relating to partnership accounting. This is part one of this particular topic. Part two I'll be taking up in the next session, in a different session. So this class has been designed in such a way so that you get to see the most important things, so in one place you get to see all the most important things which are relevant for your exams and relevant for solving the exercises in partnership accounts. So this is how the structure is. We need to understand what is partnership, why partnership, special characteristic of partnership, and accounting of partnership concerns. So this is what we are going to study, and we are going to cover the various items related to this. So we will be talking about accounting of partnership concerns, distribution of profits and adjustments, goodwill valuation. So these are the things. We will understand what is partnership. So let us start then. What is partnership basically? Talking about accounting of partnership concerns, distribution of profits and adjustments, goodwill valuation. So these are the things. We will understand what is partnership. So let us start then. What is partnership basically? A partnership is an enterprise or business carried out by two or more persons with a common goal. Okay, so when two or more persons combine, because if somebody has to do a business of his own, to some extent he can do, but after that he faces a lot of difficulties, because one is that he doesn't have enough capital, okay, to expand his business and to capture the rising markets. So there is a limitation of a capital that one single person can work with. Okay, so if two or more persons combine, then you have more capital, then you have more expertise, then you have more marketing strength, you have more contacts. Okay, so all this normally prompt a partnership to be done, and business which will be carried out jointly by these two or more persons. Okay, and that is why partnership is done. So these are the reasons why partnership is partnership accounting or partnership business are formed. So one is to pool resources and increase the capital base, to utilize the benefits of scale and to utilize mutual contacts, okay, and also increase the market share, okay, increase the market share. To capitalize on market share, to increase okay. So characteristics of partnership, okay. So this is, one is a partnership agreement exists, okay, a common business exists, the profit and loss are shared, each partner is mutually and severally responsible for one another's actions, okay. So one partner will represent the whole firm, okay, one partner will represent the whole firm. The action of one partner will be binding on the action of another partner. Partnership firm is responsible for any action taken by any partner. So not only is that the partner's action is each of the partners' action is accountable, but even the partnership firm is responsible for any action taken by any partner, okay. The partners are mutually and severally responsible for one another's action, number one, and the partnership firm is also responsible for any action taken by any partner. The liability of a firm is unlimited. The personal property of the partners can be attached in case the firm's assets are not enough to meet its liabilities. In case the partners, if the partnership firm goes for a dissolution and there are not enough assets, why does a dissolution happen normally? A dissolution normally happens when the partnership firm has less assets than its liabilities. So if that is the case, then if required, the personal property of the partners can also be attached to meet the liability of the firm. So that is why, in a partnership firm, the liabilities of the partners are unlimited. There is no limit to that. Unlike joint stock companies, where the liability of a member is limited only to the extent of his unpaid capital, okay. But here this is not the case, okay. So partnership agreement, we need to understand, okay, it is a written document that inter alia, amongst other things, sets out the rights and powers of the partner, the responsibility of the partners, the capital contribution, the sharing of profits or losses, entitlement of the partners, drawing rights and related obligations, the process, rights, obligations on admission, retirement and death, goodwill valuation method and process, the process, rights and obligations on dissolution. So these are normally the things which are incorporated in the partnership deed. A partnership deed therefore defines how the capital contribution will be made, okay. What will be the rights and responsibility of the partners? How will be the share, the profits and losses be shared, okay. What will be the drawing rights, okay, and what will be the procedures and rights and obligations if new partner is admitted, or if a partner dies, or if one partner retires. So what happens, how will be the situation handled in that case? What will be the rights and obligations on the old partners in case of admission? What will be the rights and responsibilities in case of the existing partners in case of retirement or a death? Then another most important thing that we will know about partnership accounting is the goodwill valuation. What are the methods and processes, okay, and also the process, rights and obligations on dissolution. The Partnership Act 1932. Any partnership firm created in India will be governed by the provisions of this Act, okay. This is the Partnership Act 1932. It's a very old act, but it is still applicable, okay. It is still very much applicable. It's it's still there, okay, although it's so many years now. It's how many years? 68 plus 19, so 87 years now this Partnership Act is going on, okay. But it's still there, and therefore we have to abide to the provisions of this Act. Entitlements of the partnership will be in accordance with the Act in absence of specific provisions in the partnership deed. Entitlements means what type of entitlements we are talking about? We are talking about salary. We are talking about salary. We are talking about interest on capital. Okay, maybe there is a commission payable, it can be anything. So, all these entitlements, all this, what the partners are going to get, if at all they are going to get, okay, how these amounts will be determined, what amount of salary our partner will get, what will be the rate of the interest on capital, what will be the commission to be given to a partner, okay. All these are supposed to be governed by the partnership deed. In the partnership deed, all these things are supposed to be written, okay. It should be written clearly in black and white that X partner will get a monthly salary of so much, or all the partners will get interest on capital at the rate of 5%. Partner Z, because of his extreme marketing capabilities, he will get a commission of 5% of profits. Anything. So it can be anything which is within the legal, of course, within the legal permissibility. It can be any amount, it can be any such emoluments or the entitlements of the partners. Okay, all these things will be written in the partnership deed. Okay, and one of the major entitlements is the profits. So these profits are there. Okay, so how will the profits be distributed to the partners? Okay, all these things will be written in the partnership deed. If the partnership deed is silent, then we will have to follow the provisions which are there in the Partnership Act in respect of this. Okay. So what are the entitlements? We are talking about the major entitlement is the sharing of profits. Okay, so this is as per ratio defined in the partnership deed. In the partnership deed, it will be written. Okay, in the partnership deed, it will be written that what will be the sharing of profits. Okay, so suppose there are 3 partners A, B, and C. So it will be written in the partnership deed that the ratio will be 3:2:1 or 4:3:2, whatever it is. Okay, if the deed is silent, then profit and losses are to be always distributed equally. That is most important. So if in your question, if you don't see the sharing of profits mentioned, so never mind, you just go ahead and distribute the profit or losses equally, because the rule is that if the partnership deed is silent, then you follow the Partnership Act, and the Partnership Act says that you should share the profits and losses equally. So that we must remember. Not only for this sharing of profit and loss, for all type of emoluments, we will have to do it in this fashion. Okay. There can be other emoluments also. Salary can be there, or commission can be there, interest can be, provided these are expressly allowed in the partnership agreement. If not, no such entitlements. Okay, because Partnership Act does not provide any such things. The Partnership Act is not providing for any emoluments of the partners, not provided by the Partnership Act. This is not provided by the Partnership Act. It is not provided. So therefore, this is supposed to be nil in case the partnership deed is silent. So in order to get salary, in order to get commission, in order to get interest on capital, these things should be expressly and clearly mentioned in the partnership agreement. If the partnership agreement is silent, then these emoluments are not coming up. They will not get. Okay. Interest on loan. So a partner can give loan. So that time that partner becomes a lender actually. A partner can also become a lender in that case. Partner becomes a lender. A partner becomes a lender. So if there is a lender, then he will get interest. Okay. So the interest will be specified in the partnership deed again. It will be specified in the partnership deed. If the deed is silent, then interest on loan should be provided at 6% per annum. It's fixed. This is as per the partnership. As per the Partnership Act. Per Partnership Act, the rate of interest is 6%. Okay, accounting treatment of interest on loan. Partner's loan account should be credited and not capital or current account. So this you must remember. Always for treating interest on loan, you should always credit interest on always credit the partner's loan account. So the journal entry should be interest on loan debit, to partner's current account. In case you pay it off, then it's fine, to bank. If you are not able to pay it, then please debit interest and credit partner's loan account, not to partner's capital account or current account. What is this current account will come. Okay. Next is our drawing rights. Okay. Interest on capital and salary. When there is not enough profits, okay, may be paid if the deed does so specifically provide. Now, if there is no profit, how can you pay interest on capital and salary? If the partnership deed says that even if there is no profit, interest on capital and salary should be paid, then go ahead and pay. But if the partnership deed is silent, then if you do not have profit, you cannot get interest on capital or salary because there is not enough profits. Okay. Because if you take away that, there will be loss in the partnership firm, and that loss will get distributed. So it depends on what is written in the partnership deed. Okay. Drawing rights and related obligations. Interest on drawings will be charged as per rate as defined in the deed. No interest on drawings if the deed is silent. Okay. So partners will require to draw money also sometimes. Okay. From time to time they might draw money from the firm. Okay. So whenever they are making a drawings, there will be an interest element coming up. Okay. So if the partnership deed says that so much of interest on drawing should be charged, then so much should be charged on the partners. Okay. The entry will be, entry for that is partnership account, partners capital account debit, either partners capital account debit or current account debit to interest on drawings. So for the firm, this is an income for the firm. But then again, at how much, first of all, whether you should charge interest on drawings on partner account. You can charge if your deed is clear about that. If your deed says yes, interest on drawings for interest on drawings should be charged on the partners at such and such rate. Okay. But if the deed is silent, then you go back to Partnership Act. Wherever the deed is silent, you go back to the Partnership Act, and Partnership Act doesn't say that you should charge interest on drawings. Okay. So wherever the basic premise is that wherever the deed is silent on a particular matter, you have to refer to the Partnership Act and follow it, okay, and take the steps mentioned over there. Now, for interest on drawings, the Partnership Act is silent. It has not said anything about it. Okay, so if it has not said anything about it, and if your deed is not mentioning about the interest on drawings, then no interest on drawings. Simple. Okay. So now interest on drawings, this we will learn this calculation. Okay, it should be charged based on the time elapsing between the date of drawings and the end of the accounting period. Okay, so if you have drawn 500 rupees in the month of, say, your accounts is closing on your accounts is closing on 31st of March 2019, okay, and you have made a drawing on, say, 1st of March or 1st of January 2019, 1st January. So for 3 months, interest on drawings should be charged at the rate mentioned in the partnership agreement. If nothing is mentioned, then there will be no interest on drawings. If it is mentioned, then there will be interest on drawings. And it should be based on the time for which the drawing amount was outstanding. Okay. So, and there are certain thumb rules for this. Okay. So, basically you should be able to, ideally you should do it for based on the time elapsing between the date of drawings and the end of the accounting period. then the thumb rule is to be charged for half a year if the date of drawings are not mentioned. If in your problem you do not find the date of drawings, when the drawings was made. So if you do not know when the drawings are made, then how can you calculate the time between the date of drawings and the last day of the year? You cannot. So in that case, wherever date is not given, interest on drawing should be charged for half of the year. If there is a regular drawing, if equal drawings are made at the beginning of each month, then interest should be charged for 6.5 months. If the drawings are made at the end of each month, then the interest should be charged for 5.5 months. This is a standard rule. This is a thumb rule. Just a minute. So we have got a sum over here. X, a partner of X, Y and associates, has made the drawings in the following manner. Okay, 20th February 2018, 31st March 2018, 30th June 2018, 31st October 2018. If interest on drawings are to be charged at 6% per annum, calculate the interest amount. Accounting year is on calendar basis, that means up to 31st December 2018. So how do we do this sum? This is how we do this sum. So this is how we are doing. We have got the date over here, amount over here. So number of months till 31st December 2018 we are seeing. So 20th February 2018. So that means the number of months involved is 10. Okay. So similarly for this 31st March 18, 30th June 18 and 31st October 18, we have got all these months. So this is up to 31st December 2018. So this is the thing. Okay. So you calculate the product of this 500 into 10, 5,000 and all that. Okay, so you will get a total over here. Okay, so interest is equal to, interest formula is interest is equal to product by 12 into 6%. 6% is your rate. Okay, 6% is your rate here. So we get a figure of 69. Okay, where the period is required to be calculated in number of days, same method is followed, only the divisor becomes 365 instead of 12. Because these are situations where we have got very simple, we can easily calculate the months. But suppose if these were dates like 15th of So if there were dates like say 15th of say 15th of March over here, or say 15th of February, okay, 15th of February, then say 18th of March, okay, then say 15th of June, then 31st October, say 31st October only. So in this type of cases, you need to find out, instead of number of months, you need to find out number of days. Okay, and see how much is the number of days from the date of the drawing, because you cannot calculate it in months, because it can be a broken figure. So in that case, your formula will become the same formula. Interest is equal to product by 365 into 6%. It will be the same. The amount will be the same. Okay. So this is how we do. Okay. So next is distribution of profits or losses. The entitlements other than profits or the partners' losses are appropriated from the profits in the manner to the extent as discussed earlier. The account opened is called the Profit and Loss Appropriation account. We open an account called Profit and Loss Appropriation account. Okay, so we are appropriating. Okay. The account open is called the Profit and Loss Appropriation account. Interest on drawings comes as a credit item in the Profit and Loss Appropriation account. The balance in the Profit and Loss Appropriation account represents the net profit to be transferred to partners' current accounts or capital accounts as appropriate. Okay, so we first get the net profit, okay, and then after that we start appropriating. I mean, we start giving the share of the profit in terms of salaries or commission or interest on capital and all that stuff. Okay, and then we do this in an account the name of that account is Profit and Loss Appropriation account. Interest on drawings will come as a credit because it's a income of the firm. It's an income of the firm. Why it comes as a credit? Because it is a income of the firm. The balance in the Profit and Loss Appropriation account represents the net profit to be transferred to partners' current accounts or capital accounts as appropriate. We need to transfer finally whatever is remaining in the Profit and Loss Appropriation account to the current account or capital account as appropriate. So let us see this. A presents the following Profit and Loss Appropriation account to his partner B. There is no partnership deed. Okay. So Profit and Loss Appropriation account is prepared. Salary, A is taking some salary 10,000, B is given some salary 7,000. Then you've got the profit earned over here is 29,400. Okay. Then interest on capital is provided. Okay. Interest on A's loan is provided at 6%. Then profit, you see, he gets 5/7 of the profit and he takes 2/7. So there is no partnership deed. What you have seen? There is no partnership deed. That is the most important thing that we have to understand. So B feels that he has not been treated fairly. Point out if A has contravened the provisions of the Partnership Act and draw out the P&L appropriation account accordingly. Yes, there has been. The Partnership Act doesn't allow you to give these salaries. So where you have got all this? Partnership Act doesn't give you all this. Interest on capital, no. Partnership Act does give you the interest on loan amount of rate at 6%. Okay. So all this salary accounting or interest on capital is wrong. And then profit and losses, how come, from where this ratio has come? 5:2. There is no partnership deed. So this should have been equal. So B is right in saying that A is not treating him fairly. Out of 7,500, he took 5/7 of it. and he gave him just only 2/7. So that is very poor. So what is the correct profit and loss appropriation account that you are going to see. In absence of agreement, no salary or interest on capital is payable. In absence of agreement, no interest on capital is payable. Profits must be shared equally. This is what the partnership deed act says, because the deed is silent about it. Okay. Profit and loss appropriation account we will preparing by profit earned 29,400. The same thing that we have in the previous page. Here 29,400. So with that figure of 29,400, I come over here. Okay. Then I charge the interest on loan of 1,200, because that is as per the provision of the Partnership Act. Okay. That is the rate of interest. This 6% loan is as per the Companies Act, as per the Partnership Act. Partnership Act. So now you see, we share the profits equally. If this is done, then the profit and loss appropriation is correct. No salary, no interest on capital, because it is not allowed. So total entitlements to A is 1,200 plus 1,400, 100. What is this 1,200? It is that interest on loan. And entitlements taken is how much? 10,000 plus 3,000 plus 1,200 plus 5,000. This was taken by him. 10,000 plus 3,000 plus 5,000. So this is what he had taken. Right? $10,000 he took, 3,000 he took, okay, 1,200 he took, and 5,000 he took. So he took away all the money on the form, but he cannot take it. So taken more is 3,900. And total entitlements to B, how much is he entitled to? He is entitled to how much? He is entitled to the equal profit, which is 14,100. This one. So he had got 7,000 and 1,200. See, look here. He got 7,000, then 1,200 interest on capital and profit 2,000. So this was his elements taken. So he has taken more 3,900 and he has taken less 3,900. So therefore, you debit A's capital and credit B's capital to the extent of 3,900, and everything is taken care of. Everything is taken care of. So A has taken more to the extent of 3,900. So his account will be debited and B's account, capital account will be credited, and everything will be fine. I mean, if this entry was already passed, this wrong thing. If it has not been passed, then you can prepare the correct one, and then proceed. But if this was already passed, in that case, you have to pass this rectification entry. This is the effect, this is the impact. 3,900 rupees has been less paid to B. Next, this is our capital contribution. Will be mutually decided and documented in the deed. This can be decided to be fixed or fluctuating. Fixed capital means the capital account will not be touched for current year's transaction except for fresh introduction or substantial drawings amounting to withdrawal of capital. All current transactions of profits, entitlements, drawings or interest in drawings will be routed through current account. Okay. So, when fixed capital method is used, that means capital account is fixed. Capital amount is fixed. You will not touch it except for fresh new introduction which has come during the year, or if there is so heavy drawing that it will tantamount to withdrawal of capital. Okay. So, suppose if somebody's capital account is 100,000, 1 lakh, and he makes a drawings of 85,000. So, that is tantamounting to withdrawal of capital. Okay. So, it cannot be passed through current account. Okay. So, when that type of a drawings happen, it will affect the capital account, or if there is fresh introduction, naturally that will be added to the capital account. Okay. But apart from these two, other entries like profits or salaries or commissions or interest on capital, etc., whatever there can be, should be routed through current account, and the capital account will not be touched. Okay. So, this is the concept of fixed capital. In fixed capital method, the balance sheet shows both the capital accounts and the current account. In fluctuating capital method, all transactions are routed through capital account. So, just you break up the capital into two parts. One is the permanent capital, one is the current capital. Basically, you are breaking up the capital into two parts. One is the permanent capital, one is the current. So, this is the concept of fixed capital and current account. So, this is a situation of fixed capital method. The capital account remains fixed. All the current year's transactions for drawings or interest on drawings or interest on capital or salaries or commission, then profits or losses, whatever, will be routed through the current account. So, fixed capital means the capital account is not touched. All the current year's transactions are routed through current account. But in fluctuating capital method, everything will be routed through capital account. Capital contribution will be decided mutually between the partners. What capital contribution they will make, it is completely a decision among the partners. Sometimes it may be decided by the partners to change the capital contribution in their profit sharing ratio. Profit sharing ratio, so that means that you must remember that profit sharing ratio So, these are two ratios altogether. Profit sharing ratio is quite different from the capital ratio. You must remember that. So the partners at times may think that, well, we'll make our, we have got this profit sharing ratio something, and then capital, our issues are something else. So why don't we make the capital according to our profit sharing ratio? So if that decision is taken, then the partners have to contribute. The partners have to contribute, or partners may withdraw a part of the capital to make its capital in accordance to the profit sharing ratio. Following such decision, accounting adjustments will be required to be done accordingly. So now we are going to talk about something very important, which is called goodwill. Okay, we are going to talk about goodwill. Introduction to goodwill. Okay, what is goodwill? Why goodwill valuation is required? Methods of valuation of goodwill. These are the things which we are going to discuss today. Okay, so what is goodwill? Goodwill is that reputation. Goodwill is that which makes one firm different from another firm. Goodwill is that edge which makes this particular firm more desirable to the customers. Okay, the product of this has withstood time. Okay, so it has established itself over time and it has become a premier organization. Okay, so people will come to this organization only. For example, if you look at this big four audit firms, PricewaterhouseCoopers or KPMG or Deloitte or Ernst & Young. So normally companies go to these people because they have that goodwill. Because you see, any chartered accountancy firm can actually audit the accounts of any company that way. But still, the big companies go to these big fours. Why? Because they have that goodwill. Okay. Why do we buy a particular brand in the market for anything, for shampoo or say chocolate or any item that you may use? Huh? Why do we go for Kelvinator fridge or why do we go for Godrej for certain products? Because they are different. They have established themselves over time by dint of the quality of their products, by dint of the quality of the customer handling, okay, by dint of the consistency maintained in the quality. So all these things have made this particular firm different from other firms. Okay, if other firms are average, they are above that. They are above average. Okay, and that is goodwill. Goodwill is that edge, that speciality which makes a particular firm more desirable, more important than the other firm, and they enjoy that reputation. Okay, they enjoy that reputation which they have built up over time by their efforts, by their continuous efforts for number of years. Right? Cadbury's India Limited did not become Cadbury's India Limited in one day. It took years. Okay, it took years for them to establish that brand. Okay, so why then? So this is goodwill. So this goodwill can be valued. Okay, this goodwill can be valued. You can value the goodwill. You can find out that what is the value of this, and there are certain methods of that. Okay, goodwill valuation. Why it is required? It is required. Say for example, when a new partner is joining. Okay, now why did he choose to join this firm and not another firm? Because he knows that this firm is better. It is going to give him more profits. Okay, and therefore he has to pay a certain premium amount because he has been given the opportunity to join this firm, work with this firm. Okay. Say when a partner is retiring, so all his efforts he had given all this time, and that's why that firm has reached a particular standard. So if that is the case, then he must have a share of that goodwill to which he also contributed. So he must be given a share of goodwill. Okay. Similarly, in the event of a death of a partner, or if the partnership firm is bought off by somebody, then also over and above the purchase consideration, whatever is extra payable, over and above the value of the net assets which that particular company is acquiring, the value over and above the value paid or the purchase consideration paid over and above the net assets which is acquired, net assets of the firm which is acquired, is the goodwill, that extra premium. So goodwill is nothing but a premium money. Okay, and there are methods of calculation of the goodwill. Okay, so that we are going to see now. These are the three methods of valuation of goodwill. One is the average profits method, one is the super profits method, one is the capitalization method. These are the three methods which are followed: average profits, super profits, and capitalization methods. So let us see what these are. So average profits method is ascertain the average profits for a given number of years. Take the multiplier and goodwill. So the multiplier will be given you in the sum in this way. They will use this type of words: 2 years purchase, three years purchase. This type of wording they will use. So 2 years, 3 years, this is nothing but the multiplier. Okay, so goodwill is equal to average profits for a given number of years into the multiplier. What you get is called the goodwill. Okay, so my major task, this is always given. Multiplier will always be given to us. So we don't have anything to do with it. So our main work is to ascertain the average profits for a given number of years. How do we do that? Okay, so we must first of all normalize the profits. Okay, normalize and also correct the profits. So you must take off all abnormal elements of profit or loss from the profits reported. Okay, so if your profit say includes, you are doing some business in say in the motor parts area. Okay, so in your profit and loss account, you suddenly made a windfall gain somehow. You made some share trading and got say 5 lakhs rupees. Now this 5 lakh rupees share income, share profit. Okay. Now this is not your normal income. You are not sit over there to make business of purchasing and selling of shares. You are not for that. You have got your own business. But this has gone into the profit and loss account, and your net profit is increased to that extent. So when you are calculating goodwill, you must take off all the abnormal elements of profit or loss from the profits reported. Say you had a big loss of loss on fire and your stock got all burned and you could recover only a partial amount from the insurance company. So if that loss is there, you must take that into consideration, that effect you must give, because that loss is not a normal loss, it is not a business loss. So you must try to find out what is your business profits, normal business profits. That is our task. So we must take off all abnormal elements of profit or loss. So not only the profit but also the loss. When it is a loss, we must add it back. If it is an abnormal loss, for loss we should add back. For loss, we should add back. And then correct all errors identified. Now, if it is given in your problem that there are certain, a wrong capitalization, wrong charging to revenue, or any other error which affected the profits in terms of increase or decrease of revenue or expenses. Some mistakes if you have done. So, correct it. Give the correction effect on the profits so that you find out your correct, true profit. So, before normal, we can also word this word correct. So, if your profit and loss is all jeopardized and there are so many mistakes over there, so it will not be fair for you to compute the goodwill valuation directly like that. You must look at your situation and see that whether there are some errors are already there. Errors can be errors of omission or errors of commission. If you have bought a plant and machinery, you charge it to repairs. So what do? You actually then reported less profit because you charged a capital item to the expenses. Or it can be opposite also. So all these things will actually reflect these errors will reflect your profit and loss account or net profit incorrectly. So correct it. Okay. Then give effects of all errors of omission in affecting the revenue. So as I told you, there can be errors of omission or errors of commission. So errors of omission means you just did not take it, you forgot it, but you must take. You must take that effect. You did not make entries for purchases for the last 7 days in a particular year. Take it, do it. Otherwise, how can you find out your true profit, true business profit, or correct normal business profit? So we must take away all abnormalities and we must also correct all errors which are apparently there. After that, what you get is a correct average profit. This I have already told you. This multiplier will be given in the question, nothing is needed to be done about this. This will be given as X number of years purchase. So here we have got a sum, okay, you have got a sum, and then we are asked to calculate goodwill, okay. So 2014 to 2018 they have given us the figures of profits, okay. 1,80,000, 1,60,000, 2,50,000, 3 lakh, and then 3,50,000. So there is following information are further available. 2,000 profits is inclusive of 60,000 being profit on sale of investments. So you are not sitting over there to make profit on sale of investments. That is not your normal profits. So you must reduce it. 2015 profit is after taking into account an abnormal loss on fire amounting to 30,000. In 2015, 1,60,000 is the profit shown, but abnormal loss is abnormal loss. That has happened because of certain calamity, certain accident. So your actual profit for this year was not 1,60,000, it was actually 1,90,000, because abnormal loss effect you need to give to find out, to calculate the correct profits. So abnormal loss should be added. Should be added back. If you have got 2015 1,60,000, and if there is an abnormal loss on fire amounting to 30,000, so your actual profits for 2015 is not 1,60,000, it is 1,90,000, because that is an abnormality. Nobody wants to set fire to his premises or to his factory, but fire somehow caught and it spoiled substantially a part of the business. But this is an accidental issue. Fire, nobody can predict when the fire is going to come. When something catch fire. So you should add that back, because otherwise you had profits, okay, but this had to be charged to profit and loss account because apparently there was a loss. Fine, let it be a loss, but when you are recalculating your profit, you are actually recalculating your profit. Let us use this word. A machinery was wrongly charged to repairs in 2018. Depreciation of plant and machinery is charged at 20% on SLM basis. A machinery you forgot to charge, you forgot to book it as a machinery account, instead you charged it. That means you reduced your profit to the extent of 50,000. Okay. But at the same time, since you did not capitalize it, you did not provide depreciation also. So the net impact will be this 50,000, and then 20% of 50,000 is 10,000. So your net impact is how much actually? Your net impact is 50,000 minus 10,000, which is 40,000. So this is what is being done. Salaries for the month have been omitted to be charged. So add it back and charge it. Okay. Closing stock has been overvalued to the extent of 10,000. So closing stock figure they have given you, I think somewhere. But they are not given, never mind. So this is how we have done this sum. See, 2014, 1,80,000, we made a correction of 60,000, we made it 1,20,000. 2015, we made a correction of 30,000, we added it, abnormal loss. 2016, this salaries was not charged, so we are charging it, 15,000 here. 15,000. 2017 there was nothing mentioned, so it's fine. So corrected profit is 3 lakhs only. 2018 there were so many adjustments, these three. Closing stock was overvalued, so you reduce the profit. Depreciation impact, you put it over here, okay? And machinery charges, 50,000, you put it over here. 10,000 is 20% of 50,000. So we have got our average profits, which is this. Which is 12,25,000 divided by how many years? 1, 2, 3, 4, 5. One, two, three, 4, 5, 6. So 12,25,000 if you divide it by 6. Two 2019. So 1, 2, 3, 4, 4 by 5. So we have got the average profits over here, and then multiplier is given to us, and we get the value of goodwill like this, 7,35,000. Now average can be weighted average too. The average profits can be weighted average too. In this case, weights will be given for the profit for each year. The profit for each year shall be multiplied by the weight assigned to them. The total of the weighted average profit of each year should be divided by the total of the weights to calculate the weighted average profits, and then goodwill value will be weighted average profits, okay, into multiplier. Okay, so here we did a normal average. So we took the entire profits divided by the number of years and we got the figure, then we multiplied by the multiplier and we got the goodwill figure. But you can have weighted average. So for example, first year your sales is 50,000, second year your sales is 1 lakh, third year your sales is 1,50,000. So every year it is increased by the same amount. Okay, so you can easily give weights as 1, 2, 3. So when you are giving a weight, first of all, if the question is silent about the weight, don't do anything about it. Don't have to do weighted average. If they have asked you to calculate the goodwill, and they have not given the weights, don't have to put weights. Just do it in the most normal manner. But if they are silent and you see a very clear rhythm of the profit arising, then you can also give weightage and calculate the weighted average goodwill, weighted average profit, and then multiply it by the multiplier and you get the goodwill value. See over here, if these weights are given over here, you get a figures of get these figures of 4305,000 and divided this by 15. So you get the weighted average is 287,300 and goodwill is 8,60,000. How much goodwill did we get in that method? 7,35,000. So 1,26,000 goodwill is more, technically speaking. Okay. So the next method that you have got is called the super profits method. Super profits is the excess of actual profits over and above the normal profits, and normal profit is calculated as a percentage of capital employed. So you need to know what is normal profits. Calculate super profits, take the multiplier and goodwill. So what is normal profit? It represents the profit earned in the industry by other similar organizations, and it is calculated as a percentage of capital employed. How do you find out the capital employed? Capital employed is equal to real assets minus external liabilities. Real assets means do not take fictitious assets, do not take non-trade investments, and unless specified, consider investments as non-trade investments. In either way, the result is same. Okay. What is the other result? What is the other formula? This is the formula. Capital plus reserves minus fictitious assets minus non-trade investments. You are going to get the same value. Okay. So here you have got a sum, and they are asking us to calculate the goodwill under super profits method. So they have also said that the average profit is 1,25,000. Calculate goodwill at 3 years purchase of super profits. Normal rate of return is employed is 15%. So here we have calculated the capital employed in both the methods. You see the same figure. So apply the percentage which is given in the question, and you will get this figure. Okay. 15% of 5,50,000 is equal to so your actual average profit is given 1,25,000, 82,500, 42,500. So that means all other firms operating in the same level okay, and doing the same type of business, they earn 15%. Okay, so if I apply 15% on my capital employed, I get 82,500. So that is if I was any other ordinary firm. If I was any other ordinary firm, I would have got a 15% return on my capital invested or capital employed, 82,500. But my actual profits is 1,25,000, and therefore I have a super profits. So goodwill is equal to super profits into multiplier, and you get. Okay, this is another method called capitalization method. It is also called the value of business method. Okay, first value of business is calculated. From value of business, capital employed is deducted. Goodwill is equal to value of business minus capital employed. Capital employed formula you already know, and value of business is the average profits by normal rate of return into 100. Okay, so here we have got a balance sheet extract. Okay, so what is our an average profit earned is 90,000, normal return is 10%. So capital employed is 4,40,000 plus reserves, which is 5 lakh plus reserve minus advertisement suspense is there in the balance sheet. Okay, so it's a fictitious asset, so you must reduce that. So you've got this 520 minus 40, so 480. Okay, so normal profits, value of business is normal profits, which is 90,000. This will be given in the question, into 100 divided by normal rate of return. Normal return will also be given. So you find out the value of business. This is your value of 9 lakh. Goodwill is equal to value of business minus capital employed. So this is how you find out the gap. Okay. Profit sharing ratio is the ratio in which the partners share profits and losses. It is defined in the partnership deed. If the partnership deed is silent, profits and losses are shared equally. There will be situations where PSR will change. When does the PSR change? On decision of the partners, excluding admission, retirement or death scenario. On admission of a new partner, or retirement or death of an existing partner. These are the situations where you change the profit sharing ratio. So with that, we have come to the end of the session. We have learned the primary things, the basic things about partnership. We saw that what is a partnership, why partnership is required. Okay, then we saw that what are the statute governing the partnership a business, which is Partnership Act 1932. Then we also saw how is profit and loss appropriation made. We also saw what is fixed capital, what is current account. Okay. Then we also saw about the emoluments of the partners. You should give it to the partners according to the partnership deed. If the partnership deed is silent, then you give it according to the Partnership Act. As far as profits sharing is concerned, it is always mutually decided by the partners and is mentioned in the partnership deed. If the partnership deed is silent, the profit should be given equally. Okay. Then we saw that what is goodwill. Goodwill is that edge, that premium which a particular firm enjoys over and above the other firms of the same type of business. Okay, having the more or less the same scale of operations. So there we found out that how capital employed is found out. So we put the normal percentage of profits in capital employed. We find out that figure. Okay, and we get a normal profit, and we see the actual profit. We compare the actual profit with normal profit, and then we get a difference. That is the super profit. We multiply that by the number of years purchase, and you get the goodwill. Wherever you are calculating the average profits, please make sure that you correct all the abnormalities and you correct all the errors. Okay, errors may include errors of omission also, so please take that into consideration. Okay, so and also you saw another method of goodwill, which is the last one, which was value of business method. So value of business method we find out by 100 into rate into the percentage concerned. Okay, we get the value of business. For the value of business, we deduct the capital employed. Capital employed is found out by either capital plus reserves minus fictitious assets, or assets excluding non-trading investments minus external liabilities. We get the capital employed. In both the methods, the answer will be the same. Okay, and that capital employed figure is used in two methods. One is the super profit method, and one is the valuation of business method. And I have given you examples also how to calculate this. So with that, let me end this session. Thank you very much. Have a nice day, all of you.